have some green, except for in the Russell 2000. Let's head to the SIBO. We've got Alan Nuckman standing by, the Chief Market Strategist at Agora Financial. Alan, what's up? You're trading IWMs because this Russell keeps spoiling the party.
So far it does. Now let's see if we can do a little bit of a rubber band snapback. But let's talk about the wow week we had last week.
Okay.
Big pop in the markets, new all-time highs obviously in the S&P. But what didn't happen is we saw the VIX get down to 13. So it was down to 2-month lows, but it didn't take out that swing low at 11. So it still has a lot more downside in that VIX, which could mean calmness and upside for the stock market. So we're right now about 20% off those lows. So I still see more upside in stocks, and I think that's going to help out the Russell as we see money flow shift to where the opportunity is.
So the idea is you see the S&P at the new high, the NASDAQ right at this as well. The Russell 2000 playing catch up. You've got a better kind of return potential there.
Right, so it's a risk-reward play. So if you look at the Russell's been trading sideways mostly between 150 and 160 since February, so that target's 170. Now that still would be shy of the August high. So from a probability standpoint, what we're looking for, there's leaders and there's laggards. And so the leaders have taken the market, and let's see if these laggards can play a little bit of catch-up with that. So the option play is an in-the-money call, a 150 call where that support level is for July. So it's got about 30 days of time there, looking for something to happen over the next couple of weeks. Now let's remember how quickly things can change. Look at how the sentiment in the stock market shifted in June. So I think that could spill over, and that could happen to the small cap sector.
All right, so you're buying the July 19 150 calls, Alan. Then are you looking at any offset as you basically wait towards that expiry, or is it just, look, this market continues up as long as you don't drop from here? How much time do you have on this before it starts to burn?
So it's the time decay is going to kick in those last couple of weeks. The Russell tends to hold because a lot can happen. It is a momentum market. But if you look at it, we're trading about 154 right now. The 150 call is $4 in the money. This option's traded about 550. So even if this index stayed exactly the same between now and expiration, you'd lose $1.50 in time value. So the time's not the big component here. We want to see a pop and see it get to 170. If it does that, this option doubles in value. So a modest move in the underlying gives us some big payoff in this play. Now you could put in a stop loss at half of what you paid. Typically, if an option loses half of its value, either the market's gone the other way or you're running out of time. So that's a money management choice depending on your risk tolerance. But look for this to play some catch up. I think it's a low risk play if the markets continue to go up and away.
All right, there we go, Alan Nuckman. Up and away. We'll see if the Russell can join in. Appreciate it, Alan, as always.
Thank you.
Thank you, sir. We'll be right back. Let's talk some more about the macro situation that has been the case for bonds. We know the yield curve inverted, and it stayed there. Now the market wants the Fed to undo its actions. We're going to talk to the professor behind early yield curve research, so we got to figure out some answers here.